Hey, so just so I know who's in the room here, how many people are at a venture fund? Can you raise your hand? Great. How many are, good for you, LPs? And how many entrepreneurs do we have? Okay, so pretty good mix. So I'm going to keep this topic, it's going to be pretty broad and relevant to all the different groups. But I'm going to talk about why, as a venture investor, it's actually more important to focus on retention than growth. And that's a very controversial topic because today it seems like it's all about growth, thunder lizards, unicorns, all that stuff. We're going to really talk about why retention is also important. So I'll talk about IVP, I'll talk about the SaaS market overview. I'm really focused just on software here. Our firm does all of technology. We'll talk about ways to measure SaaS efficiency. So when you're looking at SaaS businesses, what are the metrics you want to look at? And then finally, I'll talk about why retention is king. So IVP, we've been in business for a long time. We have cumulative capital of over $4 billion. These are some of our portfolio companies. We actually raised a fund in 1980 that was $22 million. I think that was about 10% of all venture capital in that year. Our market share has gone down, but the fund has gone up. We're excited to be in business. We have a $1 billion fund that we focus on right now. It's just tech only, consumer and enterprise. We're different in that we just focus on late-stage companies. These are companies that are often more than $10 million of revenue or more than 10 million users, mostly in the United States, although we go as far as places like Finland. We're in Supercell and in Klarna in Sweden, in SoundCloud in Germany, but most of the investments are in the US. I'm one of the 6 general partners at IVP. We've done over 300 investments, 99 IPOs. I think that is likely a record in Silicon Valley. Our 99th IPO was Mobile Iron a few weeks ago. Our 100th IPO is confidentially on file, so excited for that. Some of our larger investments, Twitter, which we did in early 2009, Zynga, which we did in early 2008, Supercell and Snapchat were both done about a year and a half ago. Dropbox was done about 3 years ago. And so for the purpose of this talk, I'm just going to talk about our SaaS portfolio and some of our SaaS investments. We've done over 18 SaaS investments. These are some of them. We've even invested in some companies like Concur, which started off as a license model and transitioned to SaaS. So have some experience doing that. And the most recent 2 SaaS investments are Zendesk and Zenefits, which I both worked on. We're differentiating ourselves by starting at the end of the alphabet, so instead of the beginning, so hopefully we'll beat all the firms that start with A investments. So that's us. Now let's talk about the SaaS market. So things have changed in the SaaS market. How many people have seen this chart before? Not a lot of a few people. These are revenue multiples for SaaS companies, public high-growth SaaS companies, from 2012 to 2014, and you can see that something changed a couple months ago. For the last basically 2 years, the revenue multiples of SaaS companies grew unabated. So it started off, a good multiple would be maybe 5 times forward revenue. That was an aggressive multiple. That went all the way up 2-3 months ago to 12 times forward revenue. It was incredibly hard for us to find companies to invest in because we think that's too expensive. The market corrected very quickly, and in 1 month went from 12 times forward revenue to an average of 7 times forward revenue. And it's basically stabilized in the last couple months. And so the market's radically changed. And really what happened is, in this next slide, companies no longer were rewarded for explosive growth at all costs. So if you look up in the left of this chart, March 5th, 2014, it's a little bit hard to read, but this shows the correlation between revenue growth and revenue multiple. And you had companies like FireEye that were basically trading at about 18 times forward to 2015 revenue for a company that's growing about 45% in 2015. That's what's predicted. Literally 2 months later, that same company that's growing exactly the same, they did not change their projections. It went from 18 times forward revenue to about 4 times forward revenue. So the market dramatically changed. The one thing that didn't change was if you were actually a low growth company, your multiple really didn't adjust. But all those high growth companies in that left part of the chart, they all got compressed down. So the market's starting to realize that it's not just about growth. And secondly, they're also starting to realize that you can't just, it does matter how much you burn. So these are a list of, there's about 34 companies that have gone public in the last couple years, software IPOs. This charts the last 12-month EBITDA margins of the company. And as you can see, there is a lot of red. 27 out of these companies went public not making money for the last year. Only about 7 of those companies were actually profitable in the year before they went public. This is very typical, but I think what is different is that the scale of some of these burns are enormous. And the company right on the very far left side is Box. It hasn't gone public yet, but it's a business that's burning well over 100% of its revenue. It's losing every year. So the market is, I think, historically has rewarded these companies, and now it's a little more focused on the efficiency of the business. So measuring SaaS efficiency, and efficiency is really important. And I want to tell a little bit of a story about this car here. This is the Thrust supersonic car. It's the fastest car. It broke the land speed records for cars actually in 1997. No one's broken it since. This was in Nevada. This car went basically a top speed of 760 miles per hour. So incredibly fast growth. The only problem, it gets 0.04 miles per gallon. So not very efficient. So I thought about this. I said, and it uses a jet fuel engine. That's the problem. But basically, I thought, well, if I had one of these cars and I used my tank of gas, I've got about a 10-gallon tank. I got a smaller type car. You know, how far could I get on 0.04 miles per gallon? And I actually calculated I could get from here to Union Square in San Francisco, full tank of gas. That's not very far. That's like 8 blocks. So those are the high-growth companies that are not that efficient. Now, there are other companies that are a lot more efficient. This is a Chevy Spark EV hybrid car. This doesn't go as fast. It's not breaking land speed records. It goes 89 miles per hour, about what the average speed on 280 is. The miles per gallon, 128. So on that same tank of gas, my 10-gallon tank, I could drive from San Francisco to Denver, Colorado. So much more efficient. So I think the market is changing from rewarding the Thrust-type companies to some of these Chevy-type companies. And so I'm going to talk about 2 ways that you can measure the efficiency, the miles per gallon of your startup. And the 2 ways are measuring what's called the magic number in SaaS, and secondly, measuring lifetime value divided by customer acquisition cost. Those are the 2 metrics we use at IVP. So how many people are familiar with magic number? Does everybody know the concept? I'll explain. There's not that many people, so I'll explain the concept. But magic number basically measures the return on your sales and marketing efficiency. So the formula here, which was introduced, I think, by Josh James at Omniture, we're an investor, is you take the gross profit of your company in the current quarter, you subtract the gross profit of the company in the last quarter, so the change in gross profit, you multiply by 4, so it's the annualized change in gross profit, and you divide by the previous quarter's sales and marketing expense. And basically, the concept behind it is, for a fixed amount of sales and marketing expense, how much incremental gross profit or contribution margin do you get on an annual basis? And if this magic number equals 1, it basically means that you break even on your sales and marketing expense in 1 year. If the metric's 2, it means you break even in 6 months. If it's 0.5, you break even in 2 years. So here's an example, Zendesk here. Zendesk just went public, one of our investments. You can see the change in gross profit, 16.1 minus 14.8, multiplied by 4, divide by 11.4, their previous quarter's sales and marketing expense. You've got a magic number of 0.44. That means they break even in about 2.3 years. But the magic number is not only the most important thing. That really only measures how fast you break even. What's most important is, what are the rewards of your business once after you've broken even? So what's the ultimate lifetime value of a customer? And so for this, we look at gross profit per customer. This is, again, contribution margin. We're not focused on revenue. I think too many companies just look at revenue. They don't look at what their gross profit is. What's the contribution margin, the quality of that revenue? We multiply then by the average customer life and divide by customer acquisition cost. So if you imagine you sell a product for $1,000 per year at a 70% gross profit margin, your customers churn 20% per year, and that's basically a 5-year average life. If it costs $500 to acquire a customer, the math, this works out to 700 times 5 divided by 500. You have an LTV to CAC of about 7 times, which is very, very strong. So for all of our investments we make, we're actually looking at both these 2 metrics, magic number, and LTV to CAC. Just graphically, how we visualize this, the magic number is how long it takes that blue line to break even. The time period, basically, that's what magic number measures. LTV to CAC basically measures how big the rewards are after you've broken even. And so both are incredibly important. We're targeting basically for what I consider a good company should have a magic number above 0.5x. That means it breaks even within 2 years. Ideally, it's 1x on a gross profit margin. Those are very difficult to find. And then we want an LTV to customer acquisition cost of more than 5x, which really means you're retaining your customer over an incredibly long period of time. So these are the two, I think, most important metrics. Now, notice I didn't say anything about how fast the company's growing. Those are important too, but this is just the miles per gallon, the efficiency of the business. So I'm going to talk a little bit about in this next session why we actually think retention is underappreciated, but it's actually king. So 2 examples. I know there's a lot of math in this presentation. 2 examples. Now imagine there's a company, Company A, very fast-growing company. It's growing new revenue every month at $200,000 per month. But unfortunately, it only retains 90% of its customers every month. So it has 10% churn. If we model this out, 3 years later, that company will be doing about a $2 million monthly run rate. Not bad, but pretty flat. It flattens out because basically of that churn. Now Company B, it's only growing half as fast. It's growing $100,000 of new revenue every month. But this company is a lot more retentive. 99% customer retention every month. You model this out, after 3 years, this company is doing $3.1 million. And so why this is important is we all meet companies every day, and they say, well, we're growing $200,000 of revenue a month. Is that a better company than one growing $100,000? It depends a lot on their ultimate retention, because 3 years later, you would have been better off picking the $100,000 company. So we've divided the world into 4 quadrants. We like 2x2s. We divide the world into high-growth companies and low-growth companies. And then we divide software companies into high-retention companies and low-retention companies. And so if you're high-growth, if you're low growth and low retention, unfortunately, the world doesn't really care about you. We call this is a sloth company. Apologies for anyone who loves the sloth animal. But kind of ignore them. If you're high-growth and you're low retention, so you're that Company A type company, you're a hair company. You're a business that's growing really, really fast, but you're going to get tired. If you're high retention but low growth, we call those tortoise companies. So you're not actually going very fast. You're kind of like the Chevy, electric car, but you're getting to Denver. You're getting there in the end. So for those, remember the parable of the tortoise and the hare. And then finally, if you're high growth and high retention, those are the best companies, the unicorn companies. Talk to me after. We love those companies. So we're going to do a few case studies on some companies that fit in this category. So the first case study is a public company called AVG. AVG Technologies, it's a security software company focused on consumer security software, really interesting freemium model. It grew really fast from 2007 to 2012, a CAGR of about 47%. But then in the last 3-4 years, the CAGR has been 6%. So what happened to the business? Well, if you look on the bottom, they've announced or they've talked about their consumer software churn being as high as 30 to 40% per year. So they're losing 30 to 40% of their customers every year. They have to make up that difference with new customers that can often be incredibly difficult, and the business is stalled out. We call this it's a treadmill business. Imagine that you're at the airport and those people, the moving walkways, you're going the other way on the moving walkway. You have a moving walkway of customers you're losing. You got to run even faster just to get to the same space. So it's a treadmill type business. Now, on the opposite is a company we did invest in, Concur, which I talked about earlier. So Concur is a tortoise business. That company is growing 28% CAGR, but has consistently grown year over year. And in the end, got to be a pretty big business. And then finally, a unicorn company, I think really highly of Workday. Workday is a business with great retention. It probably has negative churn, 3 to 5 year customer contracts, but has also got really high growth. So this is the business you really want to focus on. So those are the two. And then I'll finally add that it's hard sometimes to figure out who's a tortoise and who's a hare. Companies don't walk in saying we're a tortoise, we're a hare. You really have to go into the metrics of the business. And I'll end with just a little bit about how we measure those metrics. We spend a lot of time looking at cohort conversion, cohort revenue over time. So this shows for 100% revenue for once you sign a customer, how much of that revenue is retained year over year. These are cohort curves. This shows that basically the company is getting better. It's retaining more customers over time. And this is how we use these cohorts to actually build charts on revenue and look at what are the cohorts underneath the revenue looking like. So if we just look at this chart, this is a company's revenue, a hypothetical company. You could say this company is this a tortoise or is this a hare? Well, to try to actually figure out if this is a good or bad company, we look at these cohort curves and we look at how this revenue is composed. This is an example of a tortoise company, of a negative churn company. For every dollar they sell, more and more, they get more dollars in the future. So all these cohorts, these bands of dollars on a per month basis are getting bigger and bigger over time. This is going to be a very sustainable company. This is the opposite. This is a company like AVG where you're getting lots of churn over time. So this is one of the most important things we look at. We're not just focused on revenue. We're looking at the underlying metrics. And that's why we believe really to be a good investor in the software space, it's all about making sure you're focused on retention. So thanks. I'd love to take a few questions. I've got about 3 minutes. Yeah.
What is high churn and what is low churn?
Yeah, so exactly. So I would consider, it depends if you're small, medium business, or enterprise. I think for small, medium business, a good retention number on an annual basis would be more than 80%. That's hard for a small, medium business, but that's good. If you're selling to big enterprises, it should be over 90%. So high, and you want to look at that both on an account basis and also on a dollars basis. Per year, annually. Yep.
How much basically lifetime value? Lifetime is often used to justify lots of things in enterprise, but especially early in the cycle. What's your comfort level with the lifetime value since it's one of the measures?
Yeah, well, the biggest, so when we're looking at lifetime value, we want to see actually a history of what they've done before. So as a late-stage investor, you get that data. Sometimes an early-stage investor, as you mentioned, it's, who knows? But we do look at churn, and if you even if you know monthly churn or annual churn for the first year, you can make assumptions about future life that can always change. And then we really try to be conservative on how many dollars per customer, what are those? And we really just use what's the company currently making on a gross profit contribution basis. Yeah?
SaaS has been a hot space for a while, and there's been a lot of growth capital available. So what I'll see a lot is a company, they might get an A or B round, get some traction, and then they raise this big round, and they spend a lot of money on sales and marketing.
Yep.
And I'm just curious, do you see, not IVP, but do you see out there companies that might have a kind of mediocre product that had a lot of buzz, or they were in a hot space, and they're spending a lot on, and there's a lot of spend on sales and marketing out there for companies whose core product is mediocre?
Yeah. So the question was, do you see spending on crappy products, but but they're spending a lot of money anyway? Yeah, we do, and that's what we try to, in our diligence, we really try to dig into how strong the product is. And if you've got a crappy product, you're probably going to have crappy retention, right? And so that's why we're really focused on retention as opposed to one of those, the hair companies. But we do see people raising money for products that are that are not great, and that eventually gets not rewarded in the end. Yeah. Yeah, so the question was, have private company market valuations reset? Not as much. That's what's so ironic about the market is that you saw that 44% decline in public valuations, that maybe that resulted in a 10% decline in private valuations. It wasn't that high. Just to give an example, we bought in the Zendesk IPO, that company raised money 2 years before the IPO at a price that was 20% higher in the private markets than where it ultimately priced its IPO. So, and if that company were, I think, raising private capital, it would have had a higher price than its IPO price. So one of the things we like about our model at IVP is that we can make selective public investments, and so it keeps us disciplined on, hey, if we're deciding between a high-priced private SaaS company, maybe we're better off buying a public SaaS company at a lower multiple with the same growth. Got one or two more questions? Or one last question? Yeah?
Early stage firms, what's our strategy for here? If we start here, should we invest or?
Don't invest in the hairs. Look at retention as early as possible. Does it have a great product?
Retention is not good, even though they have very fast user acquisition.
Yeah. I mean, maybe you can grow real fast, sell the company before anyone notices, but good luck. Okay, thanks everyone.